Hello, it's Dale here from theinvestmentjourney.com. This is my first video where I'm going to present a stock I've been analysing. I've been taking quite a detailed look into some of the junior miners and associated companies, especially those that are on the AIM stock market. So I'd like to just go through kind of some of my findings here. And of course, firstly, like to add the disclaimer. You can read all the little detail at your leisure, but this isn't investment advice. It's just me sharing my own research for educational and information purposes. Do your own research, seek professional advice before making any investment, and generally look after your own finances, because I have no understanding of your personal situation. Thanks very much. So moving on, who are Jubilee Metals? So Jubilee Metals are a company which actually handles waste, surface waste from mines, and they extract additional value out of that waste material by processing it and extracting additional metals. They've historically been focused on platinum. The company used to be called Jubilee Platinum, and it's recently rebranded as Jubilee Metals. I think it's back in 2017. Now they're AIM listed under the ticker symbol JLP, and they're mainly focused in Southern Africa and South Africa itself, and of course are focused on the platinum group metals as a core focus. But what's quite interesting is they're starting to diversify, and that's part of the investment thesis about this catalyst for change, which we'll discuss in the following slide. So taking a look at them, you can see that it's actually been quite a positive change during the course of the last year. These slides are taken straight off one of the corporate presentations from Q3 last year. So you can see there was quite a jump in the share price, mainly driven from the turn to profitability that the company's had, and we'll go into that in more detail. But what you can see here is a growing revenue base and growing positive earnings, which is of course what we like to see. So I'll touch on what's driving that in a while, but I just want to take the big picture first, looking at the investment thesis through a macro lens. So what are the positive aspects of the investment case? So there's relative value in commodities in general. Currently many of the commodities are in a low period of the cyclical industries and represent relative value compared to the overall market, which is extremely highly priced at the moment, led by technology companies and other high growth industries that have low capital expenditure investment. So mining in general has been typically out of favour. Also, what's quite interesting is the global monetary policy, with all this printing of easy money. Typically in the past, and we haven't seen it yet, but quantitative easing always has been seen as a driver to high inflation and also hyperinflation scenarios. And high inflation normally is intrinsically linked to an increase in commodity prices. Now at the moment, inflation based on the normal RPI or CPI index have been deemed to be relatively low. But how long can the governments go on printing money without it having an inflationary impact? So we'll soon see. But if you believe that inflation will come eventually, then it could be a good place to be in commodities. And then finally, alongside that fiat currency quantitative easing scenario, this may well put pressure on fiat currency confidence in general, and historically that leads to a drive towards gold, towards silver and towards other precious metals, with Jubilee Metals being involved in platinum, palladium and other precious metal groups, then it could be positive for those industries. Headwinds against investing, a global slowdown is likely over the next few years. If you don't believe it's already happening, we can see that China is slowing in terms of its growth. Coronavirus at the time of writing could also prove to be a catalyst for a global slowdown. And what happens in a period of contraction with the mining industry? Jubilee Metals have a goal that they're going to try to move into copper recovery and other metal groups. Some of those groups are industrial metals, which could be affected by a slowdown. Also, jurisdictional risk, where Jubilee Metals are doing business, is generally quite challenging jurisdictions to operate. South Africa, many sub-Saharan African areas. The currency goes without saying that there's an exchange rate risk. Typically, Jubilee Metals is listed in pounds. It's making some of its money and making some of its sales in dollars, and it's exposed in terms of where it conducts operations in the South African rand and other Southern African currencies. So we just need to take that into account. And of course, the commodities themselves are volatile. And each individual commodity that they deal with has its own risks associated. Like we can see, palladium is extremely high valuation at the moment, platinum not quite so much, and we've spoken about copper, which typically follows very closely the GDP of the globe to when it rises and falls. That's why it's got the moniker Dr. Copper. So macro lens, there's really some, you've got to take into consideration both aspects here. Then looking at an industry lens, starting with the positives again, environmental regulations. So the mining industry is under more and more scrutiny to be environmentally conscious. The positive thing for Jubilee Metals is it is trying to tackle waste material and doing something positive with it, and the processes that it enacts are aimed to try to drive a zero effluent outcome for the waste, which actually improves the environmental situation with the material that it's handling. So this higher environmental regulations is squeezing the margins of the mine industry. People want to get more from the material that's been brought above ground. Jubilee Metals is providing a service to that, and it's also assisting with the environmental control of this material. So I think that's a very positive trend which could assist Jubilee Metals in the future. The second one is, I've touched on already, is the economic viability. The higher the price it costs to actually extract minerals and metals from the rock, as the average grade goes down, then people want to get more from the rock that they're bringing up. How do you do that? You try to be more economic in the way that you extract from the material. And this microscopic metals that are being extracted through the process that Jubilee are implementing from the tailings and the above ground waste is another value stream which can assist the business to make money and assist big mining companies to make higher margin. So there's a large addressable market. A lot of mining's already been done. There's a lot of above ground waste. Currently it's sat as a liability on people's balance sheets. How to environmentally deal with this waste material, and if you can actually do something positive with those tailings, then this would be very positive. So there's a lot of it. Jubilee Metals are operating near the Bushveld complex, near lots of the old South African mining hubs, which have absolutely enormous markets, but Once the technology is proven and the business case is proven, then this is translatable to many other mining jurisdictions around the world, and that could be the long-term growth story for Jubilee if you believe the company is well placed to do that. Moving on to the headwinds, the utility of the precious metal groups. So one of the industry applications for platinum and palladium is in catalytic converters. So at the moment, the environmental regulations of cars is driving those palladium and platinum to be used strongly in catalytic converters. It's really driving the market there and the demand for those metals. But in the long term, as we move to electric vehicles and combustion engines start to fade out, will platinum and palladium and other metals really have the same utility as they've got now? For me, this is a risk for the future, but not necessarily a risk for today. But still, we need to keep our eye on these precious metals that also have an industrial application, and understand what's driving the market supply and demand fundamentals. Thinking about future capital allocation, if we do end up in a strong bull run on commodities, will companies want to spend capex on extracting metals from their waste product, or will they want to make a capital allocation decision to spend that money on further exploration, for instance, in order to address and to profit from the commodity bull run? So we need to think about the capital allocation decisions. Arguably, I think there'll still be a place for getting the most from the material that you're mining already, but it's still an interesting question we have to ask ourselves. And then self-service. I guess this question I haven't yet been able to answer directly from the information I've drawn from Jubilee Metals. But what is preventing mining majors and mid-tier companies from conducting their own recovery of metals from tailings? Why do they need a third-party company to do it on their behalf? And what is the technical intrinsic aspects of Jubilee Metals' technical know-how that means they've got a durable competitive advantage in this space? And then looking really detail at the company. Tailwinds, the projects now are profitable and in operation. We can see they've transitioned to profit. The revenues are growing quickly. It looks like it's a scalable business model, both scalable in terms of repeating the processing in different locations, but also sweating the existing assets by maximising the utilisation of the existing plants where the capex has already been spent. Diversification is another benefit. They've now moved away from just focusing on platinum and palladium. They're moving to other metals, which means that an individual downturn in any one of the metals commodity price won't necessarily ruin their business case for the overall company. And then technical competence. Whilst I haven't yet found the silver bullet in terms of understanding their durable competitive advantage, I think it's clear from looking at the company that they've got a high degree of expertise within the company, and they've been operating in the precious metals group for quite some time, so they are quite well placed to lean on that technical competence for scaling the business. Investment case kind of disbenefits or risks. Will the company be consistently profitable? They haven't been in the past. Will these current profits and revenues be sustainable? It's intrinsically a project business. Can they maintain a growing quality pipeline of projects to feed them in the long term? Secondly, the technical risk. It works well when the when the projects are yielding profit, and that relies on good technical due diligence to make sure the extraction can be done at profit and at scale to extract the metals from the waste. They do have the upside, the fact that the tailings are already on the ground and that robust sampling can take place. So it's not like you're guessing what's under the ground in traditional mining, but still that technical due diligence is critical to making profit on the projects. Also, environmental risk. Yes, it's a tailwind. Yes, the company is operating on the right side of the growing environmental regulations. However, if the business had an environmental accident or some kind of legislative penalty for doing something wrong, then it would have quite significant reputational damage. So with all of these type of companies that work in mines, work in materials and the extraction business, we need to make sure that the company is operating to the highest level of safety and environmental standards, because reputation will hurt the business and it'll hurt the share price if you're a shareholder. I put it on one of the previous slides. Moat is the evidence to show a durable competitive advantage. So at the moment we see some good signs that they're in the right place, but I can't validate a moat from looking at their accounts and looking at the presentation so far. It doesn't mean to say the company can't be profitable and successful, but I haven't yet seen enough evidence to prove that it's really got one of the high quality moat in the kind of Buffett Munger way of thinking about things. Okay, some other considerations, I guess, taking a bit of Peter Lynch's kind of ethos from One Up on Wall Street. It's in an obscure and slightly unpleasant market segment, which means it could be overlooked by general investors. It's small cap, which theoretically means it's undervalued versus large cap at the moment. It's too small to feature on many index funds, so once it does, that could be a catalyst for growth if it continues to grow revenues over time. We have to recognise it is in a cyclical market. It has relatively low analyst coverage, which is positive for identifying mispricing of the market, but it's not good in terms of having external viewpoints to do due diligence on the stock overall. And generally it's not owned by a huge amount of institutions. And then one last thing that came about in the last couple of days. So I identified that there has been quite a large insider trade just happened in the last few days. So 500,000 shares were procured by one of the board at the time of putting this presentation together, which is currently the 24th of February, which is a positive sign for me that there is confidence in the future results of the business. Looking at valuation, carried out a classic discounted cash flow analysis. Took a relatively high risk-free rate premium based on South Africa, and also added a market risk premium of 5% on top. So plugging all of those things in and thinking about a long-term growth rate of about 5%, given at the moment we're projecting like a 69% growth rate in this particular year. I think 5% based on where it is probably sustainable for the medium term. Over the next 5 years, I've shown that 69% growth rate reducing down to 30 and then 20 and then 10. And that was really just to try and add some margin of safety into the calculation. But looking at that, I get an intrinsic value per share of about 9 pence. And it's currently trading at 4 pence. So from that assessment, based on my own analysis, it would seem that there's some value within the stock. although we have to be really clear here and say that that valuation is driven very, very heavily by the growth rate, and growth rate over history has been relatively volatile, and we can only see so far ahead in terms of the project pipeline. So you need to really consider that, and it's definitely, this company is definitely not a low risk, steady investment. It's not like the classic compounders, that you would see in bigger caps, but it does have a good opportunity for growth, and it could be highly profitable if it fits your risk profile. Thinking about it as a asymmetric risk reward, my viewpoint is if that growth doesn't come, then it remains in its profitability based on the last year, then it will still be, it'll still deliver me a relatively good return. If it follows this pattern or does better, then it could prove to be highly profitable. So that's where the risk reward level for me is quite good. What makes me quite interested, it's got, looking at relative valuation, it's got relatively low P ratio. It's lower than the industry, it's far lower than the market overall, and that kind of consolidates my view based on the discount cash flow analysis that there's some opportunity here, and what I've done is, just for the purpose of transparency, is just taken a very small position in the company for now. I'm going to wait for the next couple of quarters of results to come out, really look deeper at the company overall, see how it develops, and then over the next 6 to 12 months, if things go well, then start to build a bigger position in the company. But that's really everything I want to say. Just last kind of comments, obviously if you see an underpricing in the market and you believe one exists, other people have to recognise it as well, in order for it to return to its true value. So what could be those catalysts for price appreciation? Well, its recent move to profitability could trigger it. These high number of projects coming on stream this year also could be the catalyst for price appreciation, and increased profitability from high utilisation of their existing capital investments all could prove to be positive this year. And that's why that's really some of the things that I'm looking out for to really consolidate my view on the company. But I hope you enjoyed this presentation. If you want to see more or see more detailed notes, please feel free to join me on investmentjourney.com, which is a new website I'm just building at the moment, trying to put together some interesting stuff. Thanks very much. Bye now.